Thank you everyone for coming today. It's been an amazing 12 months in the aviation industry, I think, since I was last at AT in Brisbane 12 months ago with Rob. And I thought it'd be a good way to start off just to recap on where the industry's up to. And I think, we hear a lot of statistics about the industry and what's going on, and we hear about record fuel prices, and we hear about environmental issues, and we hear about security issues. But I think when you think about them all together, I think the industry is just undergoing a massive amount of change at the moment. And that's what I want to start off with. As Rob said, next year the aviation industry globally will face a fuel bill that's $100 billion higher, $100 billion higher. Now let me put that into context. The aviation industry globally goes through economic cycles every 2 to 3 or 4 years. And the losses go from somewhere in the order of minus $50 billion globally to positive $50 billion. And this has been a trend that's been going on for quite some time. The industry is subject to shock, and those shocks are becoming more frequent. But when you think about fuel as $100 billion on top of the economic cycle, we're faced with massive, massive changes, I think, in the economic climate. If you go back 3 years, you'll see a fuel bill that's increased $150 billion. And as I said, to put that in context with a change in market demand that traditionally has seen revenues and profits fluctuate globally by about $100 billion, this is an industry that is going to need to change over the next few years. And I think, airlines that have already been through over the last 4 to 5 years, 6, 7 years, we've seen massive changes in terms of after September 11th. We saw the first radical change in profitability then. And the industry just coming out of that decline is now faced with a triple or quadruple whammy of slowing global demand, a $100 billion increase in fuel bill, and a whole lot of other issues in terms of a lot of excess market capacity in the industry, a lot of environmental issues coming online, so the advent of carbon trading in Europe, and a lot of increased security measures, which alone will add tens of billions of dollars to the cost base next year. Even in Australian regional ports over the last few months, we've seen check bag screening come online, and that will add millions of dollars to our cost base for the group. So, on top of all of that, what you're faced with is an industry that tends to order capacity through the cycle, and an industry where the only thing that drives unit revenue performance, or yields as we call, or average fares, is capacity. Capacity drives it all in the long run, and airlines have tended to order capacity over the 10-year horizons, and we've seen very high capacity levels coming on globally over the last 3 or 4 years as a lot of low-cost carriers have come online, new technologies come about, and there's been a lot of fleet orders across not only the globe but more particularly focused in this region. Just to give you a feel, the domestic market in June or July will grow by something like 18 or 19% capacity-wise, and that's a huge number. For a market with a long-run growth profile of sort of 6, 7, 8, 9%. So this is the industry, a pretty bleak picture. But I think for the Qantas Group, we are positioned very strongly, as Rob said. I think the fundamentals are very sound. We're looking at one of the most profitable airlines in the world. And I think one of the interesting reports, if you look at analyst reports globally now, one of the interesting numbers that I like to look at is there's been a lot of report on what the break-even level of, for each airlines are globally in terms of fuel prices. And those numbers range from anywhere from $80 a barrel, up to about $150, $160, $170 a barrel. Now, luckily, Qantas Group is at the higher levels, and we are very, very strongly positioned in terms of riding out the storm. But as I said on the previous slide, this is a fundamental change, I think, in the industry. What are we doing? As per recent announcements, we are making changes to our network. We're leveraging the two-brand strategy, which I think, apart from, in terms of the Qantas Group, provides us a unique lever that most other airlines globally don't have. Most of the other airlines are cutting capacity. We saw in the US 18% capacity reduction by United overnight, and we've seen a lot of other capacity reductions by airlines globally. What it allows Qantas to do is maintain routes, maintain capacity with both brands, and put the best brand into the market that it suits. We're going to continue to adjust. We're going to continue to look at network changes. We're going to continue to push for further efficiencies, cost reductions, and we're going to continue to look at other sources of revenue. This is fundamental to the business, I think, in terms of survival going forward. As Rob said, the two-brand strategy has been incredibly successful. I think a quote from Jeff Dixon a week or two ago that the group would be in serious trouble had it not been for the two brands. It provides us with a unique competitive weapon, provides the ability to continue to offer our customers a choice of both brands and continue to offer the network across both brands that we would not otherwise be unable to provide. I think the Jetstar story in both isolation and in the group context has been incredibly successful. We've been profitable since startup. We've been growing at about a compound rate of about 50% per annum. We continue to grow this year, even with the recent changes and capacity cuts. Jetstar's continuing to grow at 20 to 30% per annum, and these growth rates are still quite strong. And then in combination, we're also taking interest in airlines in the region, and they're doing franchise deals, which is adding to the overall Jetstar brand growth, or the growth across all the Jetstar brand. We've been, as I said, profitable since startup, and based on our first half year's results, we're one of the most profitable airlines in the world in terms of return on investments and profit margin. Just to give you a feel for our growth rates, this is our confirmed fleet orders now, so we are continuing to grow rapidly. This is just within the Jetstar brand, and then on top of this, we're growing other Jetstar businesses in the Asian region as well. So Jetstar Pacific, the Vietnamese business, and Jetstar Asia out of Singapore are also growing quite aggressively over this same period. And to put that in context with some of our competitors and some of the most revered or some of the strongest low-cost carriers globally, you can see that Jetstar's growth rates has been much faster or as fast as the fastest growth rates we've seen globally. And this is a comparison with EasyJet and Ryanair, and just puts in perspective how fast we are growing, how many aircraft we're taking on, and how many more passengers we're carrying each year. You can see at the moment we're just passing the 10 million passenger mark, and that will continue to grow to 20 to 30 million based on current confirmed fleet orders. The Jetstar strategy is a unique one, and I think something that Australia should be proud of. It's a brand that was born in Australia. It's something that myself and a group of us worked on going back in 2003, and it was a brand that was designed within the Qantas group for the purpose of going after the leisure passenger. But it's a business that we've now exported, and we've exported it throughout Asia, and it's a brand that's highly sought after. We're in discussions with many carriers in the Asian region, and many countries and carriers want to get the Jetstar business into their markets. We provide one of the lowest cost carrier in every market that we do serve, and we provide an efficient and effective way to come into markets and really stimulate demand. Just recently, as you'll see, we've launched Jetstar Pacific. Vietnam is a hugely exciting market for us. It's a population of 100 million people, and it's a market that's growing extremely fast. There's only two airlines in that market, Vietnam Airlines and now Jetstar, and we're currently serving 7 destinations. On the 23rd of May, we converted the second airline in Vietnam, which was Pacific Airlines, into a Jetstar business, and through a franchise arrangement, they have taken on the Jetstar business, and we're cooperating with them on commercial activity, helping them out with management, and also helping them out with fleet and growth orders. So this is a business that you're going to see grow rapidly. They've got 30 aircraft on order through to 2014, and they're going to start to grow internationally into a number of destinations now. So we're going to see places like Thailand, Cambodia, and Singapore come online out of Vietnam, which provides us a unique tool in the world of aviation, where it's highly regulated. It allows us to start to connect up the dots. So it allows us to serve different destinations from different countries and access traffic rights out of each of the markets that we serve. So if you think about combining Australian traffic rights with Singaporean traffic rights and Vietnamese traffic rights, it enables us to offer a Jetstar proposition to customers through a single website, a single booking engine, and a single customer value proposition. We can now offer customers in markets that are not even in each of these 3 destinations a network that's much more comprehensive than otherwise would be just by offering one of the Jetstar businesses. So if you're in Thailand, for instance, you can now get to Singapore, Australia, and Vietnam, and a number of points beyond. And that proposition now starts to get critical mass as you add more and more of these businesses in each of the regions. This was a brand launch. So back in May, the normal Jetstar fare offering launched and the brand proposition launched with the price promise that we offer in every market that we serve. And this was the launch on the 23rd of May. In addition, obviously, we offer the direct Australia Vietnam services. And you've seen that the proposition here with 15,000 dong is quite competitive. The exchange rate actually is one that's moving quite rapidly all the time, but this was valued 15,000 dong, to put it in context, is less than $1 at the moment. So it's a very attractive offer. Today, we're launching our Perth, Denpasar and Perth Jakarta routes. They were announced recently as part of the brand shift in terms of the international rationalisation as part of the network capacity cuts and also the changes in Qantas Group flying. And I'll be announcing a fare launch offer at the end of this presentation, but you can see we've launched Perth Denpasar today 3 to 4 times a week and the Perth Jakarta 3 times a week. It's a growth of 5% based on the capacity replacement, so it's moderate growth, but I just put that in the context in the current environment. That's still quite significant given the pressures that we're seeing with fuel and economic activity. We're also establishing a new Perth crew base, and Perth will be a base of operation for us for pilots and cabin crew and maintenance and overnighting aircraft. In addition, today we're also launching the Sydney-Darwin-Saigon, which adds the 3rd aircraft to our Darwin hub proposition and starts to connect up the dots through Sydney, Melbourne, through Darwin onto Singapore now, and Saigon from Cairns as well. As Rob alluded to, we've gone through some tough times, and the group has looked hard at the Japan operations and seen forecasts of $100 million based on the $100 million loss at the current fuel price. And in reaction to that, we've had to redeploy capacity. This is in conjunction as well. We should note that the delays to the 787 have also limited our ability as a group to respond in the Jetstar brand in terms of long-haul flying. So we do not have any other wide-body capacity than the wide-body capacity we have at the moment, and that has meant that to secure the Japan flying that we needed to secure, we've had to redeploy capacity in Jetstar from markets like Sydney KL and Sydney Saigon. In the latter case, we've redeployed narrow-body capacity through Darwin to at least continue to offer a proposition from Melbourne and Sydney through Darwin. So we'll start Coolangatta Osaka on the 1st of October, which is a shift from Brisbane, and we'll start Coolangatta Tokyo on the 18th of December and Cairns and Narita on the 18th of December. We continue to focus on low fares. We believe it's a fundamental proposition to the Jetstar brand. We continue to offer the low fares guarantee. Despite all the hype you hear about airfares in the marketplace, we continue to offer that price promise. And that's been enormously successful in ensuring that the noise of different carriers talking about fares gets a cut through with consumers and making sure consumers know that we guarantee that we'll put the lowest fare in the marketplace, and if they find a lower fare, we'll double the difference. Lots of innovation over the last year, some driven for customer service benefits, others driven in terms of efficiency. I think there's been a lot of different initiatives that I'd just like to touch on. Web check-in's been extremely successful. We're seeing already initial uptakes of about 12%. It says 10%, it's about 12% at the moment. And we've deployed kiosks into 6 ports, and we're going to expand that rapidly over the next year to a number of other ports. We're seeing uptakes of kiosks in addition to the web check-in of about 40%. So you can see already we've got our self-service technology in airports when you combine web check-in with kiosks over 50%. And that's an important milestone in just getting efficiency through the airport. But more importantly, it's not just about labour. More importantly, it's about asset utilisation. Airports are highly congested in Australia, and we just don't have the room to build more check-in counters, and this enables us to grow into those airports without the need for expensive new infrastructure. In addition to this, we run one of the world's most successful carbon offset program. We have a 12% uptake. It's a voluntary program at the moment. It is the world's most successful voluntary program, though. And we get widely varying take-up rates on the carbon offset program, anything from 28% on Ballina, obviously a little bit more green-minded in Ballina, but down to an average of about 12%. It's voluntary. We've collected over $600,000 in voluntary contributions, and this has gone to offset the carbon emissions from those 12% of passengers. In addition to that, we're trying to reduce our fuel consumption, obviously through investment in new technology. We're also looking at lowering our fuel burn on our flights, and we're also looking to leverage the JetSaver Lite initiative that we launched earlier in the year, which is an initiative where we offered passengers that don't carry checked-in baggage a discount of $10. And surprisingly, there's been a huge behaviour change. We've seen about 40% of our passengers switch, and a lot of them are not carrying bags anymore. The weight saving alone from those passengers enables us to dramatically reduce our fuel burn, and that's really going straight through into the bottom line. And where fuel's where it is at the moment, these sorts of initiatives are really important. There's other initiatives. We're also looking at going to the next level with our unbundling proposition. We really focus on providing customers with choice, and rather than just focus on just price rises, we're looking at other ways that we can actually recoup our higher cost of operations by giving customers the ability to change behaviour and give us cost savings. And so we're looking at things like giving discounts for people that just use self-service technology and doing things like that. So extending our success with the carry-on bag-only proposition and looking at things like check-in. Also, our ancillary revenue production through things like Jetstar Holidays continues to grow dramatically. We've seen a growth of 30% year on year in terms of our Jetstar Holiday business, and we're now launching inbound packages in a number of key markets. We continue to focus on distribution. Over the 5 years of Jetstar's history, this has been one of the real forefronts of our innovation. And we're the first carrier in the world to launch codeshare with a full service carrier, being a low-cost carrier. The first one then to do free-sale codeshare. We're then the first one to launch marketing codeshare. And we continue to build our airline relationships up around the globe. We just recently launched an e-ticket hub, which was needed in terms of the cut over to e-ticket. So we moved away from paper ticket, which is one challenge for a full service carrier, but is a whole new challenge when you're a ticketless low-cost carrier. So we've had to incorporate some innovative ways to handle e-ticketing. And just alone this year, this is $150 million of additional revenue, largely coming from markets that we wouldn't otherwise be able to serve. And that's inbound tourism or inbound customers that are able to get to destinations that Jetstar flies to that they wouldn't be able to get to otherwise. And so not only is it good for us, we think it's really good for the tourism industry as well. So today we launch sale fares on Perth Denpasar and Perth Jakarta. They're available now, $179 one way, and they'll be available for travel through from the 27th to the 16th of December, 27th of October through the 16th of December, which is our launch date. And they're available at jetstar.com. In addition to that, we launched the Sydney-Darwin-Saigon service today, or for sale today. It's a 5 per week, so it marks an increase in frequency of 2 per week. It is a narrow-body operation, but allows us to connect very efficiently both Melbourne and Sydney into Ho Chi Minh, and then we can also, with our Jetstar Pacific network, now offer 7 other destinations in Vietnam. So it gives us a proposition to offer customers trying to get to and from Vietnam, a very compelling proposition. And now I'll take questions.